In the UK, there is a notable concern among many individuals regarding the possibility of a housing market crash. This concern is supported by valid reasons, mainly due to the significant role that the housing market plays in our overall household wealth. It appears evident that house price growth has been slowing down, particularly following the Brexit referendum in 2016. Rather than making predictions about future house prices, I intend to outline the driving factors behind these prices. This way, you can form your own perspective on the potential trajectory of prices. Additionally, we will explore a worst-case scenario presented by the Bank of England to gauge the potential severity of the situation. It is important to clarify that the following discussion does not constitute financial advice tailored to your specific circumstances. If you require personalized advice, it is advisable to seek guidance from an independent financial advisor. Let's begin by examining the factors influencing house prices. This relationship can be likened to a seesaw, where various elements either push prices upward or pull them downward. Low interest rates, for instance, reduce borrowing costs, thus elevating house prices. Conversely, higher interest rates limit affordability and tend to lower prices. The dynamics of supply and demand are crucial. Increased demand drives prices higher, while increased supply exerts downward pressure. Economic growth is a pivotal factor. During economic downturns, house prices tend to drop, whereas periods of robust economic expansion correlate with rapid price increases. House prices hold a significant position in the UK's wealth structure, contributing substantially alongside pensions. They accounted for approximately 4.5 trillion of total UK wealth in 2016. London and the Southeast experienced even more pronounced property wealth growth, with the strongest appreciation in house prices. The uncertainty surrounding Brexit has a considerable influence on the housing market's direction. Let's delve into various forecasts to understand the potential outcomes. The Financial Times, or FT, provides context by comparing UK house prices to past housing market crises globally. These crises include Hong Kong's drastic 60% price drop after an increased supply announcement, and Japan's gradual decline following the bursting of the asset price bubble in the 1990s. The specific forecast depends on the nature of the Brexit deal. A no-deal Brexit scenario could lead to a moderate recession lasting over a year, with house prices decreasing by 10% over 2 years, according to S&P. In contrast, a positive Brexit deal might result in a boost in transactions by 10%, while a no-deal scenario could lead to a roughly 5% price drop. Extended negotiations could cause transaction volumes to decrease by up to 20%. For a comprehensive understanding, it's valuable to explore the Bank of England's annual cyclical scenario, designed to test the resilience of UK banks. In this scenario, global macroeconomic stress, financial stress, and misconduct factors contribute to a severe shock. The worst-case situation projects a sharp fall in UK residential property prices around negative 33%, driven by reduced investor appetite for sterling assets, increased funding costs, and falling sterling value. Presently, as of August 2019, house price changes vary across regions, with the Southeast seeing declines while other areas experience increases. London's property prices have fallen over 4% in the previous year. The post-referendum period marked a turning point, where the rate of price increases slowed. The historical growth discrepancy between London and the rest of the UK has led to substantial disparities in average house prices. Affordability remains a key consideration, while wage growth and lower interest rates are positive factors. High price-to-income ratios indicate that substantial growth might be limited. An important indicator, the ratio of average house price to earnings, remains above the long-term average, suggesting muted price growth over the next decade. It's noteworthy that supply constraints persist, driven by an oligopoly of major builders and a lack of suitable housing for older individuals. The UK's housing market outlook leans towards restrained growth due to stretched affordability, despite positive factors such as wage growth and limited supply. It's important to note that the housing market's future trajectory is influenced by multifaceted factors, including economic conditions, interest rates, demand, and supply dynamics, as well as the outcome of Brexit negotiations.